Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Wednesday, June 10th, 2020. Getting this one out a little later than usual, but I wanted to do one. I wasn't able to do one right after the market closed today. I had something going on, but several things I want to point out. So what I'm going to start the video out with is just a very quick snapshot of what I'm usually doing, talking about price, support, resistance levels, things to watch for. And then I want to spend the bulk of the video going over some of my breadth and sentiment indicators. I don't cover those very often. Sentiment, for example, there's various types of sentiment indicators, and I only find them useful when they are at extremes, and we have that now. Anything in between the extremes, from my experience, has zero predictive value. At least I've never been able to extract much predictive value from that. So we'll get to those. As far as price goes, it's same levels I've been watching. We're going to cover all the indexes real quick. It's these trend lines here. They all have that in common, which is nice right now that it's not just one index at trend line support or near it. You have all of the major indexes. And why is that important? Well, you might trade the SPY or the S&P 500, and the next guy or gal trades the Dow or the Nasdaq Composite. And so therefore, if that's, each subset of trader sees support break, you're going to have longs exit their positions. Stops strategically in an uptrend are often placed just below a well-defined trend line, and the better defined it is, the more eyes are seeing it. And shorts will pile in as well. So that's why you get these pretty impulsive, selling after an uptrend that seems like it'll never stop, and then all of a sudden, boom, volatility spikes. And that's for those reasons. Longs will exit the positions, shorts pile in, and that's just how technicals work. So watching that trend line, we close pretty much on it today. You can see there it's certainly not an impulsive breakdown. And a couple other things we'll watch for this week. It's not just the S&P 500, but most of the indexes have the potential for these island cluster tops. You have a gap right here, Monday's gap. You have, Monday, right? Yeah, no, Friday. I'm sorry, Friday. Yeah, the big jobs report gap, of course. Friday's gap. So far, 4 candles, and if you were to gap down tomorrow or later this week, on Friday, that gives us a potential. We can continue to form this island, and if you get another gap, it's going to do one of two things. It'll give you that island cluster top, which is a pretty reliable topping pattern. You want to look for them after an extended uptrend, and it'll also clearly have taken out the trend line, broken support, and that could usher in selling. First logical support level on SPY would be a backfill of the gap right there, and anything much more than that, 302.50, and then again I'll cover price levels in another video should we get those sell signals. And so as of now, to kind of recap, if you haven't caught up on my analysis the last few days, we're kind of stuck between a rock and a hard place, between resistance. The S&P 500 had this gap. We broke down after a divergent high back here in February. And COVID was getting started, two red candles, follow-up selling, and then a big gap down, and that really started the party to the waterfall sell-off that we had into the March lows. So a technically significant gap. It capped the rally on Monday and every day since, and so that's it. That we're pinched between that support and resistance. Obviously bullish if we can get into the gap, backfill it. It's even more bullish if we take out the top of the gap, because then you're just right there, a stone's throw from new all-time highs in the S&P. You break down. I already gave you some potential targets. Let's look at the other indexes. QQQ. We've got a couple different boards, but we'll just look at this one. Forget about all the lines, focus right now on this line. This is the near-term uptrend line that we're looking at on QQQ. I'm going to get to the Nasdaq Composite in a second. You know what, this one might even, let me see if I can pull it back here like the Nasdaq Composite. That's it. So I'm going to color this one up real quick, and that trend line comes off the lows right there back from March. So we'll color that one up in yellow and tighten it up here a little bit, come into all these candles. So that's the trend line. It was a smaller one a minute ago. I've just extended it down there. And, I think I already had an alert, but either way, there's my alert. Tells me if that breaks. And then I get an alert on SPY. I see the Dow break down. Let's look at the Dow. DIA, comparable trend line right there, closed right on it. Similar potential for an island cluster top should we gap down. If we don't gap down and we break down, then we break down, and that's still a sell signal, especially if it's impulsive. Logical for support would be a backfill of the gap right there, And should that go, we're going to start breaking back below some of these moving averages. I don't know if you can make it out there. I'll turn it up a little bit. 200-day simple moving average is in blue, which comes in right at that gap. You can see, perfectly. So big support. And if I had a lot of confidence in this rally and I was looking for all-time highs and then some in the market, that's where I'd be stepping in to buy. I'd rather take maybe start a short on a break there, add if that level goes below that is the 200-day exponential moving average as well. So plenty of support on the way back down in the markets. And again, we'll take it one day at a time. Right now we're in an uptrend without sell signals, so we have to go from there. We do have some sell signals, of course, in the small and mid caps. This is IWM. Let's look at, we can look at this one. IWM had a solid red candle today. That's what you want to see on a breakdown. We're down 2.72%. Big impulsive candle solidly below the uptrend line. So there's a sell signal right there. It did backfill the gap. It closed right about on it, about 146. So now what will happen is, again, buyers may step in there. There's a gap backfill. It's a logical place for a bounce. But if the large caps break down tomorrow or soon, then it will most likely drag the small caps down below that gap. And so those are things to look for. And I'll follow up with price targets soon. Should we get some additional confirming sell signals? MDY, I don't talk about them often, but these are the mid caps, mid cap 400 S&P 400 mid cap index. It's a big part of the stock market. These are more the household names, companies that more so than the small caps. Usually focus on the small caps. They're volatile. They're a good trading vehicle, but so are the mid caps as well. And there it is. We broke down actually yesterday on the mid cap. It wasn't very impulsive, but then boom, impulsive follow through today. Backfill the gap as well, also right at the 200-day simple moving average. So you have a sell signal on the mid caps and the small caps, but you really need to see the large caps break down to get some more out of this. Otherwise, the buyers could step in there. Coming off overbought levels, PPO starting to turn down. So those are other potential bearish developments right there. And then finally, I'll talk about, I don't cover it often, but the Nasdaq Composite Index. Remember, the NDX is the Nasdaq 100, which is obviously the 100 largest stocks within the Nasdaq. This is the Nasdaq Composite. It has about 15 or 1,600 stocks in there, a little more diversified than the Nasdaq. It was up 0.67%. Remember, of all the major indexes I just covered, all of them were red. Most importantly, the diversified index, the Dow, the S&P 500, and the Nasdaq Composite was up 0.67%. Now, let's take a look under the hood, because this video is all about market breadth. So when we look at the Nasdaq Composite index, this is how I gauge market breadth on any index out there. A lot of indexes, there's only a few that they will report market breadth on, but if you take, this is something I figured out years ago, just go look at the holdings in there, the components, sort them by percentage gainers or losers, which I've done here, and then scroll down. Scroll down till we don't see any more green in this percent change column right here, and that is right here at this point. And I click on Monster Beverage, MNST, and down here at the bottom it tells me that that's 406. So 406 out of the almost 1,600, or 1/4 of the stocks in the Nasdaq 100 were positive today. The rest were either flat, most of them were down. So that's very bad market breadth, especially considering that almost 0.7% gain. Why? Again, what I've been saying, it's what this whole video is about. After an uptrend has been going on for a while, one of the signs that it may be in jeopardy, you're starting to see some cracks, is what we call deterioration in market internals. Fewer and fewer stocks are rising, and because the reason you get the positive gains on the index is because they have a higher weighting. Microsoft, Facebook, a 1% gain in Apple makes up for probably 3, 4, 5 dozen of the bottom tier, the smaller companies in the Nasdaq, being red that day, down 1%, because Microsoft has a huge, over $1 trillion market cap, and so it moves the needle a lot more. So I just wanted to point that out. And then on the Qs, I should have showed you that as well. QQQ, a very impressive 1.2% gain. But when you look at the holdings there, you can see, let's see how many were red today. Let's go this way. Start here, we go all the way down. And so 50 out of the 103 stocks in the Nasdaq 100 actually lost money today, were down, yet the index posted a very impressive 1.2% gain. Once again, a la the big names, the ones everybody loves, Tesla, Microsoft, Apple, and those names. So again, poor market internals. Yes, it's a gain. You might say, well, Randy, I don't care if I trade the Qs. I don't care if XYZ stock is rallying. Well, again, it's these aren't sell signals. 1 day or 2 days or even 3 days of bad internals doesn't really. It's not a sell signal, and it may just be shrugged off. But when you see, and as I'm going to show you on these indicators, a persistent trend of a deterioration in internals, that's when very often you get some major turns in the market. And even the S&P 500, it is cap weighted, meaning they put a higher weighting on the larger companies, but not nearly as much as heavy weighting as in the Nasdaq 100. But with that being said, it was down about I think it was negative 0.56% today, down about 0.5%. Yet within the S&P 500, as you can see here, about 400 of the 500 companies, that's 80% of the stocks, were down. Why was it only down with 80% of their stocks down? Why was it up? Well, there it is. Microsoft, Nvidia, some of the big names, Apple. Again, those guys doing most of Amazon, doing most of the heavy lifting. Okay, and now we'll look at some of my favorite breadth indicators, and then we'll get to a couple sentiment indicators, and we'll wrap this up. I'm going to go through this relatively fast. You can see the charts. You can pause the video and take a look, but I'll just show you what I'm looking at here. Explain this. That's why I like to do the videos. All right. This goes back. We're going all the way back to 2001. So we're encompassing. This was the Great Recession back here. 55% bear market. That went from 2007 into the lows in early 2009. Since then, these were what's highlighted in red were the major corrections. They were all close to 20% drops. In fact, this one was over 20%, over 30%, and so they're all highlighted. What do they have in common? Well, here's the thing: when the market when a market has corrected, or you're during a healthy advance, you should see the advance decline line. That's what we're looking at here, the Nasdaq advanced versus declining issues. If I wasn't clear, there it is. NAAD, the Nasdaq Advanced Declining Issues, and up top, Nasdaq Composite. So in a healthy advance, think back to that strong rally in 2016 that went all the way up to the fall of 2018. Very powerful trend, and this was telling you more and more stocks were advancing than falling, as they should be. Finally, it came to an end. Same with these other rallies here. Same with the bull market off the lows back in 2009. That's when the bull market was over. You saw the Nasdaq Composite rallying, and you saw more stocks advancing than declining. But between there, over this past almost 20 years we're looking at here, there were a few periods, and these are red flags, where the market was going higher, the Nasdaq, and the number of stocks within the Nasdaq were not. The number of stocks advancing versus declining. And so those are the cracks you look for. And again, they foreshadowed each of those big drops. In fact, the only time we didn't have it on a big drop was right here, that fourth quarter meltdown in 2018. But we identified the top pretty much to the day back then, and also when the lows came in. So there it is, pretty powerful stuff. And look, here's the thing right now. We had divergence forming into the big drop that we just had. It was clearly telegraphed. I covered that in advance back at the time. Covered this indicator back then, and you can see it there. So the NAAD right there, boom, that was your divergence. So why am I doing this now? Okay, we got our correction, Randy, you pointed out. Well, guess what? Each and every time that was it was over. This time it's not. The Nasdaq has made a new high, while the NAAD has not. In fact, the divergence has gotten even more steep. The slope of the line has steepened at this point, just like it did back here. Remember, this was last bull market. We had a little shot across the bow, and you can see we went a little higher. The divergence was steepening, and then boom, there was the big drop. Okay, so that's what I wanted to point out, that this appears to be, bear markets, even corrections usually don't end in just one single wave like they just had. There's almost always multiple waves. And so while this is carried to new highs, you might say, well, you can't say the Nasdaq's in a bear market anymore, it's at an all-time highs. Again, it is unique because of the weighting, the top heavy weighting. The rest of the stock market, the S&P 500, the Dow, everything else has not made new highs yet. So, and this is again showing you a red flag here that we have not taken out those previous highs. We still have the divergence. In fact, it's only gotten larger, thereby indicating a much larger drop to come should these divergences play out instead of being burned through. By burned through, I mean we come on up here, we continue to rally, and then no longer have divergence once we take out these previous highs. Okay, I'm going to move on. I'm going to go through a mixed bag of different indicators that I use. This one is the NAHL, the New Highs, New Low Index for the Nasdaq, with the Nasdaq Composite on the bottom. You can see there are some boxes down here showing you the previous bear markets. There's the 2007 to 2009 bear market, those same big corrections that we had along the way during the bull market. They're all boxed in right here, including the one we just had. And what do they have in common? Well, back then, leading up to the 2007 top, we had a very well-defined trend line on the NAHL. Stocks, more stocks. So we have our little corrections, but we were in a bullish trend. And then before the bear market started, we started to oh no, I'm sorry, that's the channel, that's not divergence, both were going up. What I look at on here, we broke the trend line right there. The trend line broke, and that signaled we entered a new bear market, and until this line turns up, and then it did. So when this line's headed down, you're in a bear market, and when you break trend. This was one of the longest and strongest bull markets in history, or the longest and strongest in history. And back here, when we had this first drop down into the lows recently in March, we had a solid sell signal. That long-term trend line I've been tracking for a long time finally broke, and we're well below it right now. So that's something to note there. That's again just one of many indicators, but that would say that this is most likely, that was the end of last great bull market, and probably more downside to come. Okay, same indicator, but I'll give you a different spin on it. Up top, we have the Nasdaq Composite Index. Down below, the same one, the NAHL, the Nasdaq New Highs to New Lows ratio. And same thing you can see here, divergence along the way. Again, just hit it real quick. Negative divergence leading up. This doesn't look like a lot, but that was the great bear market back there in 2007 to 2009, 55% drop. And again, all the corrections along the way. You can see my divergence lines without fail. The biggest, all the bear markets and the biggest corrections in the past decade or more were all preceded by these clear negative divergences between the new highs to new low ratio and the Nasdaq Composite. And there it is. So divergent high number one, correction one, and those divergences extended, became larger, you get a larger correction. And the thing is, we didn't even have divergence at this point leading up to that big 36 or whatever percent drop. We sure as hell do now. Big divergence at this point. You can see that sharp drop off. And again, is this 100%? No, because what could happen? We could go up here and take it out. But I can tell you that that divergence will not be taken out anytime soon should the Nasdaq continue higher. And again, you want to play odds and statistics, probability, that's what I do. This tells me that this will play out, and it will most likely be for a significant correction when these play out. The thing about them, just like the divergences, the bullish and bearish divergences I highlight all the time on between prices on a security or index and the momentum indicators. Remember, these are not momentum indicators. These are breadth indicators. But the momentum indicators are the PPO, MACD, RSI. Just like those divergences are not buy and sell signals, they're just a heads up. Hey, we're looking at a likely trend change coming. So now at this point you want to start looking at breaks of support and resistance, and one of those breaks will likely be the trigger for the next big trend change. And so that's where we're at. So let's fire through the rest of them a little bit quicker now that I've kind of explained. But it's interesting because these are all different indicators, or some of the same indicators used in different, all telling us the same thing, that there's a lot of cracks under the hood right now, despite this, the Nasdaq Composite going to a new all-time high. Okay, and I showed you, I believe earlier, the NAAD. That's the Nasdaq Advanced Decline Issues. This is a weekly chart, so these are weekly readings on that indicator. So you have the Nasdaq Composite below and the NAADW, meaning weekly, above. Long term, we're going back 20 plus years here. You had a bear market, a huge bear market back in the 2000, the dot-com bubble. Big bear market, clearly had strong divergences. In other words, the Nasdaq Composite was rising with the advanced declining line falling. Same thing back here. You had the last bear market, everything was rising there. The Nasdaq Composite was rising into that leading up to the 2007 to 2009 bear market, and the NAAD falling. So you can see the divergences, each and every one. This one's actually been continuing for quite a while. We've had just a series of consecutive divergences, and this is something I've noted. I haven't really talked about it. I mean, I've showed it here. Let me jump over to something. I'm kind of going off on a tangent. I've showed you a megaphone pattern for a while forming on SPY right here. This is a weekly chart, big megaphone pattern. And what makes up that megaphone pattern? What stands out to me is you can call this a bear market, you can call that an almost bear market, or you can say this is just one big secular bull market. But one thing is for sure, is that volatility has been, or the corrections have been getting larger and larger. We had a little one there, a bigger one there, and a much bigger one here. It kind of reminds me, fortunately I don't live out, anywhere where there's, tectonic plates rubbing together like you folks out there in California and all that, so I've never really experienced an earthquake. But, from what I gather, you get these little tremors. When the big ones hit, sometimes there's those early warnings. The plates are rubbing, you get little quakes, little tremors. And they might increase in frequency or magnitude, and then the big one comes. So, This is, and it's also indicative of Fed policies. They're every time you have the market corrects, the Fed comes in and refuses to let it down. They refuse to let the economy go into recession. They throw everything they have at it instead of letting the business cycle run its course. Recessions are as natural as the seasons. They're necessary for the economy, and the longer you put those off, it keeps dead companies, zombie companies afloat that shouldn't be, and you create excesses and imbalances. And so, longer term, again, that's my take on it. I can show you that, but it's a pretty clear, megaphone pattern, big expansion of volatility. So, what's the next one going to look like? This doesn't look like, this is not the end of a bear market. Here's a bear market with waves. You can go back in time. You can see here's a bear market with waves back into the 2003 lows. This is what bear markets look like, not this. So by technical definition of drop of 20% or more, that 36% drop in SPY was a bear market. But to me, it just looks like a big, massive corrective wave in a market that looks to be topping here, and scary stuff, at least what I think. Okay, so back to that. I think I already showed you. So, big wave, bigger corrections, and if this one, if it was over, if there wasn't anything else coming, if we didn't have these divergences, I might say, then we might not have anything else coming. But again, this new high in the Nasdaq is clearly, the divergences are getting more steep. The slope is increasing on that divergence line. It's been building, little shock waves, and then bigger. So just something to note right now that, like I said, by just about every metric I'm looking at, the rally in the Nasdaq 100, as powerful as it is and convincing as it is not healthy. There are a lot of cracks forming under the hood. And again, I'm picking on the Nasdaq or highlighting on the Nasdaq because it is the only index at high. So you don't have divergence on the S&P 500, the Dow, the small caps, mid caps, because prices haven't made higher highs with any of these breadth indicators making lower highs. But you are seeing the internals, as I started the video, showing at least as of recently in the Nasdaq, or I'm sorry, the small caps and just about everything else deteriorating. And again, maybe it's an aberration, maybe it goes away, maybe they just needed it. It's an overdue correction. Maybe not. But again, you got to zoom out to these long-term charts to pick up on the trend. So what we're looking at on this one, yet another indicator. This is the Nasdaq Advanced Decline Line. Nasdaq Composite down below. Same story. We're going back to the previous bear market back here, or the bull market leading up to the 2007 highs. This is the stock market, or the Nasdaq Composite, I should say, because you want to use, if I'm going to use a breadth indicator on the Nasdaq, if I want to look at the NYSE, I'll look at the NYSE indicators, breadth indicators. You want to compare apples to apples. So that's why I have the Nasdaq Advanced Decline Line clearly deteriorating, and that was, foreshadowed that 55% bear market. Doesn't look like a lot here, but it was one of the worst bear markets in history right there. And then some big corrections along the way that may not look like much, because when you put it over this long-term period, you had such an enormous bull market here. But they all had the divergences in common. And again, the point I'm trying to make here is we had divergence on this indicator clearly foreshadowing or leading up to that big 36 whatever percent drop, whatever it was there in the Nasdaq Composite. And maybe it would be over. We'd have an all clear signal if we didn't have these divergences. So where we had the divergence there, they've only extended at this point. You can see that the advanced decline line is not keeping up with prices. It is lagging behind. Again, showing you what I showed you earlier. More stocks falling lately than rising, despite the market going up. And yet another. We're almost done with these breadth indicators, and then we'll just look at a sentiment indicator or two, maybe a couple of those, and then wrap up. So a couple more charts and we're done here. All right, this is the NALHR. This is the Nasdaq new highs to new low ratio. Down below you have the Nasdaq Composite. Up top you have the new highs to new low ratio. I should have expanded this chart, but this is just to the left of the chart. Here's 2000. So there's our dot-com bubble. Market was ripping, especially the Nasdaq, ripping up the highs, and we had divergence coming to that point. So that bear market, that vicious bear market that followed, was foreshadowed by divergence, showing you the ratio of stocks making new highs to new lows was falling while the market was still going up. We had the same divergence here. That was the last great bear market there, 55% drop from 2007 to 2008, and all the corrections along the way. Same thing, divergences, divergences, divergences. When you're in a very healthy market, you should have the new highs to new low ratio going up with the market. That's the market going up, and so was the ratio there. So it's these divergences you look for, and so there it was. You had a divergent right here, divergent high, and that big drop back in the fourth quarter of 2018. And then what happened from there? We've continued to diverge. We have not taken out those previous highs. We had divergence here at this point, and we have it once again. Until and unless this line pops above there and makes new highs, we have just a series of 1, 2, 3 consecutive divergences. And typically, the bigger the divergences get, the bigger the drop. Just like you had a decent drop there. It was a big drop, biggest in years. An even bigger drop there, and that would seem to indicate an even larger drop to come. And just when you probably thought I couldn't come up with another indicator to show you how the market looks under the hood and other internals, this one, and this will be the last one, then we'll move on to just two more that'll show sentiment extremes. This is the NAA 200R. That is the Nasdaq percent of stocks trading above their 200-day moving average. So as one would assume that during a healthy uptrend, more and more stocks will be trading above their 200-day moving average, and that's usually the case. However, here's that 55% bear market in 2007 to 2009. Towards the end of a bull run, you start seeing fewer and fewer stocks trading above their 200-day moving average, yet the market still continues to rise. So it's these divergences we look for. There they are all marked. You can see the percentage drops, 19%, 20%, 10%, 19%. drop there. I didn't measure it out. A bigger drop, 22. And again, you can see just a series of consecutive but increasingly large divergences. The same divergence has been building. That's why we're getting these bigger and bigger drops. This arrow was drawn here before we even dropped. I had highlighted that divergence back then in this last red arrow. That was about a 30% drop in the Nasdaq. Remember, the S&P fell even more, and so now I've given you an even bigger arrow. Now the arrow is not drawn to scale. I'm not predicting the magnitude of the next drop, but I do predict it will be bigger and will undercut those lows, which at this point in time, I think the percentage of people that are at this point calling for a break of those lows has diminished into a very, very, very small number, is my guess. Again, just what I'm thinking, especially on Nasdaq 100 and Nasdaq Composite. So that's it for breadth indicators. There are more out there, but those are the ones I'm looking at. And again, I picked on the Nasdaq because we don't have divergence in the other ones because they haven't made new highs. Sentiment indicators. Let's go here, and we'll look at those. Here we go. And the one I want to look at first is the CPC. Let's look at it here. Okay, so on the CPC, that is the total put to call ratio. That is the ratio of put options, which is a bearish bet. If you buy a put, you're betting a security will go down. It can be a pure play bet that something's going to drop and you profit from that put, or in many cases, and a lot of times they're used as hedges to long positions. And so I have really two lines on this chart, and I've shared this one for years, and again, like I said earlier in the video, anything in between these lines, there's my buy line with a secondary buy line, but the big green line, when we hit this extreme, you want to be buying stocks. You want to step in. Fear is excessive. This is complacency. When the put-call ratio plunges, everybody right now wants to buy calls because they think the market's just going to continue to go up at the rate it has been. This is over time, this stuff never changes. It's the psychology of the masses that they didn't want to buy back in early March, but they sure want to buy right now. And you can see the numbers here. When we hit that line, sometimes it's a one and done. Here was the last bear market back in 2007 to 2009, 56% drop, one and done. We hit that extreme at the top. Everybody wanted to go, we're bullish. They wanted to buy calls. They didn't want to buy puts. And here, sometimes you get a cluster of readings. So what happened, we didn't get a correction the first time or the second, but when you have these readings in close proximity, I refer to that as a cluster. They're not spaced far apart. And then finally, boom. So it shows you, excessive bullishness, and then boom, the correction sets in. There was a one and done, 21% drop. Double tap right there, two in close proximity, followed by a 10% drop. Four of them right there. Even one, a little one right there, 2, 3, 4, in very close proximity. 16% drop that lasted for this, and that wasn't just a quick in and out. I think people are also getting spoiled on these V recoveries that we had the last two, and probably, the last one, they probably think we're going to see this again, and continuation of that, and then the market taking off, and that's why you'll probably get a very powerful move down once people realize that's not going to be the case. But what I'm getting at is usually corrections, and this one took over about a year or more to finally get to that before the market had bottomed and resumed the uptrend. Like everything, and I like to point this out, there's not any one indicator that's 100% effective. If it was, this would be super easy. Everybody would be using it. So here's an example. Now, I'm also going to say this. One reason this one didn't pan out is we had just come off this was a near bear market. In fact, the small caps, mid caps, the majority of sectors had a bear market. They dropped over 20%. Just the broad market, it didn't drop. It fell a little less than 20%. And so when you get that right after a correction, you already had washed out a lot of bullishness already there. So really these indicators are useful after the market's been rallying for quite some time. And that was it. This was the first one right here that we had in years, all the way back since late 2016, or was that early? Yeah, about late 2016. And we got it right there shortly before the top came. So that gave you a heads up. Don't chase rally. That was before COVID even was a thing right there. It looks like late 2019. And you had that reading. Where am I going with this? Well, today we have the first reading since back here telling you that everybody has just resigned. The mass, I'm speaking in general, of course. The majority of people think that's it. COVID's over. The correction's over. We're on to a new bull market. It's going a lot higher. I want to buy calls. I don't care to have puts. And then likewise, when you hit that green line, you buy. Hit the green line, you buy. Hit the green line, you buy. You get it. So pretty good stuff here, and that's why I put these lines at extremes. And I wanted to point that one out for you. And last but not least, what's my next one up? CPCE. So here's the total put to call ratio, and if you want to look at just the put to call ratio on equities, stocks, in other words, puts on Apple, Amazon, things like that, we look at this one here. What do I see? On this one, I have a line, as you can see right here. It's about looks about 38 or so right there. We hit an extreme. Last time we hit that same extreme was right here. That was followed by a pretty good correction at that point, and even then the market really didn't go much higher. This was what I refer to as a deer market. That's not my term. It's a deer market. It's neither bull nor bear when a market goes sideways for an extended period of time, and we had nearly 2 years of sideways trading after that extreme. We did have a correction and followed by a few more corrections. The only other time, again, we go back in time, we had it right there. Big old drop came afterwards. We had an extreme right there. Big old drop. So pretty good stuff. This one came close, but first of all, we were coming off the end of a bear market, so really you want to look for these after an extended rally. We're looking back here, what is this, a decade of history. Pretty persistent, or consistent, I'm sorry, pretty consistent. Not a lot of data points, got to give it that, but again, I wanted to point that out. We haven't seen this extreme as strong as this rally has been. I've been watching these indicators day after day, and a little surprised that it took this long for the masses to become so bullish. And to wrap it up here, I would encourage you, if you are a subscriber to the journal, I believe the articles, sometimes I'll let some of their articles be released. You can Google the headline, just click on it, see if you can get it. Individuals roll the dice on stocks as veterans fret. And what it goes on to talk about, I can't show you the whole article, it's paid content. But they talk about how Warren Buffett dumped his airline stocks, after this thing started, and they've rebounded like crazy. Carl Icahn had dumped Hertz, and they talk about Hertz, and they go through a few examples of people. One guy put all his savings, he had $50,000 to his name piled in Hertz, and so these people look like geniuses because these stocks have went up. Hertz, as you guys probably know, filed for bankruptcy protection. A lot of the airlines will probably go that route eventually. They've done it many times in the past, and the point they're trying to make is pros. These are not just the hot fund manager du jour, Buffett, Icahn, these guys won out. The rally is being driven in large part, as sentiment shows, by not just your average, not just a regular retail investor. A lot of these people, at least in this article I interviewed, have no investing experience. One person, took got their government stimulus check and put a big chunk of that into these speculative stocks, and they're buying low-grade companies. So it is a large part. They go on to cite that. They talk about how brokerage accounts like what is that, Robinhood, that app, TD Ameritrade, some of these brokerage accounts have seen a surge, up, I forget the numbers, but it's significantly higher new account openings this time compared to last year, a year ago, showing you that the retail investor, the type that is known to, if you read up on this, time and time again, that is the one almost consistent trend in the market, that after an extended rally, you get the retail investor coming in and buying stocks, and with very little, if any, due diligence or experience in doing so. So again, that's been a large part, the driver of the rally. Undoubtedly, the Fed stimulus has been a large part of the rally. Hard to know how much institutional buying or selling, but I do know, as I showed you earlier, Treasury bonds continue to rally, which is also a red flag for the market when you're seeing Treasuries. Another strong day in Treasuries today. The risk-off assets shows me the institutions. Gold rallying hard back toward the middle of the trading range. So for the first time in quite a while, I'm seeing just in the last few days, not really a very strong or long-lasting trend, but a clear trend of a lot of red flags or cracks in the rally at this point. We need those sell signals, but you have the risk-off assets going up, you have tremendous deterioration of market internals, and you also have a lot of those high-flying junk stocks. You're starting to see them roll over now. Hertz in the last couple of days, although it's still well off where it was when it filed for bankruptcy or announced it would be filing, down 40% in the last couple of days. If you continue to see these junk stocks fall, that means those retail investors that thought they were genius coming in and buying these and the airline stocks you'll see them start to have that pain threshold where they, most of them probably came in here and here and here. So that's what I'm watching. I'm watching a lot of these stocks that where the retail money's chasing. And of course, Apple, Amazon, Facebook, that goes without saying. All right, we're going to wrap it up here. Long video, but I wanted to get out those market internals to you and the sentiment and all that. And again, at the end of the day, those aren't sell signals. These are or will be sell signals if we get these trend line breaks, and and then you watch what happens. If we just have a little pullback like we did before, for the last few months, every pullback was bought up, or what happens when we get to that support, because that's where you start to get the what I call WTF moments, where the dip buyers say, oh, there's a big old fat gap, I'm going to buy that gap and then ride up the next wave. And if you blast right on through there as if it wasn't there, that is about one of the most bearish things you can do. At least you should have a reaction there. If you don't, it tells me then there is a pretty crowded rush for the exits and not a lot of buyers waiting on the sidelines anymore at this point. That's the whole thing about sell-offs and rallies. When the last seller has, weak hand has sold his or her share and capitulated, that's when stocks bottom. And when the last long or bull has bought his or her last share, metaphorically speaking, that's when a rally ends. And, we'll only know that in hindsight for sure, but we can look for some early signs, again, via breakdowns and sell signals and other things like that. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great evening.